The broadcast is now starting. All attendees are in listen-only mode.
Low-Face Warriors and welcome investing.com. Thank you very much, Craig. All right, so last trading day in the U.S. this week. Tomorrow, people celebrating Passover. Hello, Nick. And Good Friday. And basically, I'll celebrate both of them. It was the same dinner. Passover Seder, Last Supper, same meal. All the guys got together. Hi, Russell. How are you? Okay, so when you get to the markets here, this candle surprised me. I've been looking for a rollover. So here we are on the verge of breaking out in the Dixie, everybody. And so what am I doing? Well, I'm going to fade it. I already have. And I'm risking about 30 pips over this high to see whether or not there really is a breakdown. Because, when I look at the euro and it's a weakness today, we're about halfway back of this whole advance. I still think there's another wave up. Something that would convince me I'm wrong would be, maybe closing over the ECB spike that we had this day. I think this was the ECB back under 1220 or so. Then I think we're headed for new lows. And if that's the case, and the dollar breaks out, this is where the euro could go. Now, I believe the euro is going to go to this level. The question was, and as I look at the weekly chart, failed where it had to, right? Under the 50 week, 1330. I believe the high was about 1325 or so. My belief was they were going to try and shake out the bears first before the euro collapses, and that would take a move back over. It's like what's this high? 1448, and here's a 200. It's uh, 114.84. So that would be enough. But if we're going to break down, it's just beginning. So, you don't have to really feel late about the dollar here if you want to go with the breakout. So I'm just giving this descending triangle a shot because, maybe this was the last burst before the descending triangle begins to manifest. Of course, we're going to need closes back under 97, 96.80 to activate it. Everyone with me? My view on the dollar? And actually, I was probing the Aussie, but it didn't pop with the euro, but the Aussie's holding right where it has to. And right here. And there's still a shot for another push up towards 72.40 if the dollar can roll over one more time. So that's currency. Okay, any questions before I move on? We have a great guest today. Don at Seven Sentinels is going to be with us. He informed me the high in 1929 before the crash was April 19th. So a lot of things happening over the holiday weekend, anniversary-wise in markets. So you know what one of the greatest things is about ForexAnalytix that you won't find anywhere else? We're allowed to express ourselves here, okay? Most services, and I know some, fairly popular ones, they have to go with the main guy. So he could have a staff of great analysts, but they toe the company line. Similar to, when the banks come out with a recommendation, do you see different viewpoints from that bank? No, you get one view, one recommendation, and everyone has to find reasons to line up with whoever is in charge. Here, it's so democratic, and as you can tell, you look at active tickers, okay, it's fairly understandable with euro being sideways for such a long time. These are yellow lights, and so neutral, everyone's neutral here. But you'll find as you scroll down the tickers that there's neutral and bullish. bearish, neutral. Here's everything on the MEX, right? Neutral, bullish, no, don't touch, bullish, macro, candlesticks, basic technical, harmonics, and Elliott wave. That's another, um, I think, unique feature of ForexAnalytix is that, and everyone who is responsible, Greg Horvat, he wins awards on FX Street every year. I interviewed him once when he won an award. Here's Andre. He does the harmonics, basic technical. Both Steve and Blake do it. Steve mainly does candlesticks, and macro is Stelios. So as you can see, it's okay for everyone here to have different views. And do you go to a doctor and not get another opinion? When you buy a car, do you only look at the body, or do you open up the engine? And do you bring it to your mechanic? So I think if you're a self-directed trader, you want as many views to consider in formulating your trade plan as possible, because you only have two eyes, right? And other people are going to see something that you didn't. And once you see what they're looking at, you might have a few aha moments. Everyone with me? Anyone know a site that, let me know if you do. Anyone know a site where they have 5 different styles of technical analysis and allow those styles to have their own independent view for you to weigh out before you click your mouse? Anyone else like that out there? I know a lot of you guys go everywhere, especially if it's free, right? If it's free, it's me. That's what a KJ buddy of mine used to say. No, I mean, just different views, different styles, harmonics, Elliott, that kind of stuff, Craig. Anyway, good luck on your search. I don't think you'll find anything like this anywhere on the net. So I want to get back to a few things, and I have a couple of macro calls here, okay, that I think that if they're managed correctly, they could be big trades. So since we can disagree on things, so you see how I set myself up, I've been talking about looking for shorts in copper for about a week or two, and it was a week early. We had this reversal week up here, so I drew this line here, and then we had one more marginal new high. So far, we haven't even gotten to the 61.8 level in copper. Can we take another stab up here? Maybe. Could we have a throwover like we had in crude? Maybe. But it's my contention with S&Ps 1%, not even 1% from new all-time highs, NASDAQ making new all-time highs, all the great news from China. Look at this action yesterday. Okay, so I'm very negative on copper. I think that there's going to be a whiff of global slowing, and copper could take a big hit. So sell rallies is the way it looks to me in copper. And when you look at the weekly chart here, if we're failing from 61.8 and we start taking out this low, which is, we hit a little pullback and then new high, almost looks like a 3 drive, doesn't it, guys? Then back under 282, it's clear sailing to 262. And I actually think that we could have something like this. You see this wave? Caught this wave out in Cardiff at Swami's. Okay, this was a wave from Swami's in Cardiff by the Sea. And this, if it had equality, is going to take it down here. And if it ends up being a fib extension, it's going to take it down to, 220-ish or so. So very bearish copper. Is this a good class? It's really not a class, Andre. So here's one of my, if you handle this professionally and you hold a position. You could trade off a position. The guys here on the team do it great. Steve does it great. Blake does it great. They're not all in, all out at the same time. They realize you can't be perfect, and you have to let your trades breathe. And sometimes the market will give you a chance to build a position by not having immediate gratification on trades. Okay, so this is a big picture trade. I'm bearish. I think there might be some contrarian views here. And when you look at copper compared to the S&Ps, you'll see. Okay, so S&Ps are up a couple again today. See, we're almost at new highs compared to copper having a 61.8% retracement. So also, you want to short the weak sister. So, even if you're bearish at the stock market, are you better off shorting copper or trying to top pick the stock market? And actually, the way it looks right now, and no one's talking about it, it's lower on the week. I don't know what's going to happen when the Mueller report is released later. And everyone thinks that it's a lock for sure. We're going to new all-time highs because we did do that in the NASDAQ, right? We got made marginal new highs in NASDAQ. Dow's not close, S&P very close. What if that doesn't happen and we start peaking in here? I think it's very possible if we get some bad news to see a pullback to 2,800, initially 2,780. I think it's going to happen in the next several days or week if we're going to start going down on this area. So copper, bearish, okay? Stock market, correction, okay? Copper, I'm looking for new lows. Stock market, retrace from the December lows. And the last one, which there are a lot of bulls in right here, and I started putting positions on yesterday, is the crude market. So crude and copper, right? What do they have in common? Oh yeah, 61.8 they have in common. Okay, so just like the market and uh, the indexes, crude hasn't rallied back to the highs it had before the crash. We're 61.8 back here, and what copper and crude have together have in common is they're both about industry and economically sensitive, right? And probably have a lot to do with China. So if China's really recovering, copper shouldn't break down, right? Or crude. And I'm not saying that I could be early on crude, but I just want you to take a look at this. So this was a megaphone formation. Okay, and I was short here and I got squeezed out. Us technicians call this a throwover. So how you really trade a throwover is you wait for it to get back inside the wedge line, which today comes in just a shade under the low we had the other day at 63. I'm not saying that we can't make a new high, but I will say if we start closing back under 63, that may seal it for a correction. Okay. And even if we make a new high, the 4-hour will not confirm. I'll add on if we take out the buy stops. And yesterday I put one on because I said, I always wait for stop hunts. I mean, that's my handle, Forex Stop Hunter. But I was running out of patience. It didn't take out the stops here. The stops are here, 6.4, 6.4. So it wouldn't surprise me if it did it before it turned down because it's given a lot of people hope. Didn't take out this high here. Didn't take out that high here. Didn't take it out here. Okay, when S&Ps were strong and everything. So maybe it won't. So, I would rather have a toe in the water and be a little bit early than turn my head and be trading euro or something like that and then miss it. So, I have a partial position on it. And then should we get back within this formation, it's viable for a retest of the January lows. Of course, there people are going to be buying breaks and This could take a long time to happen, and it may not happen, but you know, we've rallied from 42 to call it 65, $13. Why can't we have a 50% correction? Take it back to here, 58 or so. So these are my big calls and what I'm looking for. So I need some market confirmation back under this megaphone wedge line. And Joe, see the team? Joe saying we have a 3 driver in S&P. What time frame, Joe? 4 hour, 1 hour? Yes, 1 hour daily. Okay, well, look, the 1 hour looks pretty good here too. So what Joe's talking about is here we had a confirmed high, drive 1. Here we had a new high, diverged. And the ideal setups are when you have a third drive, which was this candle, and there's glaring divergence between the prior two. Okay, so that ties in with a lot of things like negative copper, and if you've watched crude and S&Ps, they've been Siamese twins. So that's a way. Those are my ideas, and I'm sticking with them until they blow me out. And anytime you go into the market, if you have this thought, I hope this one works, you haven't done your work, because you need the attitude of a warrior. And that attitude is, okay, Mr. Market, I've done my work. I've thought it through. I know how much I'm going to risk and where I'm wrong. I also know that when I'm right, what I'm looking for. Go ahead, prove me wrong. And if you have to write that down, do it, because that's the attitude you need. Because if you're trading out of weakness and fear, every jiggle's going to just shake you up, and you need to go for a walk. Okay. So I want to wish everyone a happy holiday. I'll be around for the interview. Stick around for Don Mead at 7 Sentinels, and we'll see if any of his Sentinels are getting weary at their posts after this massive recovery in equities. So thank you, Face. Consider joining us, and this is just a tip of the iceberg here at our free webinar. You have guys like Blake and Steve and 100 pros in the private members chat. You have Paulie setting you up before the U.S. Open and the European crossover. I know a lot of people that really admire the skill set of Amanda and her trading, that she does it live in front of everybody. And what an opportunity. How many people would want to hang out with Blake over the years, and he shares all his stuff, the good, the bad, and the ugly in there. And Steve drops in when he sees something important to share it, because we're here to help you succeed, and especially not step on landmines that all of us have done before. So we all learn the most from our mistakes. We hope you learn from ours and you don't have to go through it yourself. So happy Easter. What's your question? Can you pick up the divergent? Oh yeah, Andre, you know what? If you can't, it's not a good divergence. And that's what I teach. If you have to move your mouse, like see these two, and go, I wonder if it diverged. And it's good to know it diverged, right? And it did. But if you have to move your cursor to get the number, it's not a good divergence. They should be glaring like this, and preferably under 70 are your best shorts. And you look for a couple of them. Okay, I hope that helps. That help? Yeah? Cool. How you doing, partner?
Hey, good morning, Coach.
Blake Morrow, how are you?
Good. I've got about 10 minutes to cover
Oh, I'm sorry.
Something.
I
Oh, no,
took
no,
too
no,
much
no,
time.
no. Don't worry about it. I got about 10 minutes to cover something just before it happens here
Okay.
on the dollar Canadian. We do have Canadian retail sales today. Now let's keep in mind all the data that we have coming out just this morning. So you know we had all the European PMIs obviously, and then we have now Canadian retail sales. We have U.S. retail sales, which are going to be the more important pieces of data here in the next 10 minutes. All right. So um, now you guys are pricing the euro, and just really quick, the euro's broken an uptrend line. We're in a bearish wedge. The support probably is around here, maybe the 1230 level, whatever. I'm more concerned about the Canadian this morning because of what happened yesterday, and we have Canadian retail sales that are coming up really, here in just a few minutes. And when you're talking about Canada, and you're talking about retail sales, the retail sales that we're looking for today, and as you can see right through here, okay, 0.2, 0.4%. Previous were 0.1% and negative 0.3%. So you're looking for a beat for Canadian retail sales. However, I'm gonna tell you, if the U.S. retail sales beat and the Canadian retail sales miss, we are setting up for a pretty big rally in the dollar Canadian here, because what you saw yesterday is this triangle, and we had the strong Canadian data yesterday, right? And you can see here's from yesterday. The Canadian data that came out yesterday was the CPI, the trade balance numbers. They came in, you know, higher, and you can see the trim CPI, medium CPI all came in higher. The dollar Canadian came down, stopped all the stops below the lows, below this 133 level, reversed. And when you get a false break down, then the risk is the opposite direction on a breakout. So in this case, a move above 133.20, I'm sorry, 134.20 is what I meant to say, it is going to be pretty bullish. And I would actually be looking at 134. So if 134 gives today, okay, a continuation move above the resistance is probably pretty high. And keep in mind, we have this big inverted head and shoulder pattern. We still have some distance to travel. And so I think the risk is for a break higher. Like I said, what we're going to have to see today is weak retail sales out of Canada, and in line, or stronger retail sales out of the US, but really focus more on Canadian data, because it's got everybody turned upside down. And I think that is a big risk for the pair right now. For those of you that were on yesterday and we were talking about the US dollar Mexican peso, I did buy it yesterday down here at 1882. I had a small position. I got out of it this morning when we were at 1887 up here, and it's come down a little bit. But stocks are looking a little weaker. I'm not going to go too heavily into equities, but they are looking a little weaker from the ascending wedge. You were just talking about a 3 drive on the daily chart.
Yeah.
If stocks actually start to show some weakness, I think the dollar Canadian, dollar Mexican peso are good candidates for higher prices. And like I said, all we need today, this morning, is a little help with with some weaker Canadian data. We get a little weaker Canadian data today, and that's what and it just because I want something obviously doesn't mean I'm going to get it. Just because I want some weaker Canadian data doesn't mean it's going to happen. And I'm not an analyst. I'm from a bank where I'm scrutinizing and plotting all the different numbers. I just look at how I'm going to react to the numbers. So in this case, if I get a weak Canadian number and a stronger US number, I think the trade is, for a squeeze in the dollar Canadian. And if it doesn't happen that way, can I short the dollar Canadian? Can I play it, some Canadian strength? Sure, I guess, but that's not the trade I want. And so what I do as a trader is I think about what are the different scenarios and how is it going to play out and how am I going to play it. Like I said, I think a lot of people got stuck short yesterday. They got squeezed. You've got the market that's probably a little long Canadian dollars here. Thinking, oh, equities are, going to continue to strengthen. I want to buy commodity currencies, whether it's the Aussie or the Canadian or the Kiwi. I want to continue to buy those commodity currencies, sell dollars. Well, you know what? That trade's gonna reverse if we see a little bit of risk aversion and we see some weaker Canadian data today. So that's a trade that I'm wanting to happen today. Doesn't mean it's going to happen. That's the way I want to play it, though. I want to play a breakout here, and then because this is let me draw with a pen, and then I'm going to pass it over to Steve here in 1 minute. So Steve, get ready. So if we break above here, that's where I start my long. We break above here. I add to my long. I hopefully can, bring my stop right to break even, and then hopefully ride it out to, 134, 130, 134.50, 135 later on throughout the session. So that's the way I'm looking to play it. All right, Steve, Stelios. Good morning, guys. Happy Good Friday Eve.
Hello.
Good morning. So hey, so everybody knows, we're not going to be broadcasting tomorrow. It is a holiday tomorrow. We are observing Good Friday. It's a Good Friday. Most of the market will be completely dead. FX market will be open, but unless there's some sort of tape bomb that hits the markets, chances are we're going to see tighter ranges that we've been seeing, which is hard to do, hard to see, tighter than 20 pip ranges in the euro, but we could quite possibly see that tomorrow. So, so we won't be broadcasting, but we will be back on Monday. And so you guys ready for a nice 3-day weekend?
Yeah.
Yeah, it's not going to be exactly a weekend for me.
Oh,
I
come
have
on.
things to do for work, but it's going to be fine.
Don't be a Debbie Downer, Steve.
Yeah,
No one wants to
really.
hear it.
Yeah, I got
All right, I'm passing it over to Stelios. Stelios, you got the chart.
Yeah.
How about you,
Well, people
Stelios?
just want to enjoy a little bit, Steve.
Yeah.
God,
Good.
put on a
it's good.
smile.
No, you're gonna have fun, right? You're gonna have fun with the kids this weekend, right?
I'm
I
actually
have.
going
I'm
to
gonna
take.
have. Go on.
Yes, Philip?
I was going to say we have 2 weeks of no school coming up, so I'm going to have the kids with me at
Yeah.
home 2
Oh,
weeks.
God.
Not bad.
Ooh,
I like it.
lucky.
My kids, I can hang with them, but when I got a couple little girls, I don't know, man. I wouldn't want to be going to ballet class. Anyway, you guys, hey, have a great one, everybody.
Oh,
and,
Stelia
thanks
loves
for
his
tuning in.
tutu.
All right, good luck
Right.
on the
Have a
Canadian
good
data.
weekend. Hey,
You guys
happy
too.
Easter and Passover, Blake.
Yeah, same to you all. Happy
Thanks, Blake.
I just one of my friends was making chocolate covered matzah balls,
Oh.
and I was like, man, that sounds good. All right, gotta go. See you guys.
All right, mate.
Okay.
I've never heard of
Okay.
that.
We have
Yeah,
some.
we celebrate Passover.
Yeah, but I've never heard of that. Chocolate covered matzo balls. They go in soup, man. Matzo balls. Anyway, what do I know? I was bar
crackers
mitzvahed
with
at 13.
chocolate on it.
All
It's
right.
crackers with chocolate on it. Okay, I gotta go. Bye. See you.
Here we
Okay.
had the false attempt of a breakdown. Yes, Stelio, we covered
Arul
macro stuff
Satado, no.
after the data because we are only a few seconds away. Keep in mind that USD CAD still remains trapped within this triangle. We have US and Canadian data, as Blake said. That's why we're going to monitor here on the 4-hour chart the reaction of the USD CAD. And of course, Stelio, give us the data as soon as they are out. Any second now, actually.
We have 30 seconds. And actually, within those 30 seconds, can I just answer one of the questions from my friend Andre,
Absolutely.
who's saying, are there any webinars that run which are more explanatory for beginners? We don't have any webinars like that now. We do have an education site. If you go to forexanalytix.com/education, you will find a nice list of patterns and analysis types, which is a very good place to start. And the reference.
And there is a possibility actually that we're going to have some in the future. I mean, from more amateur traders. So Stelio,
Okay,
data time.
numbers. Let's have a look.
There we go.
Canadian is beating. American is
Yep.
beating. Yep.
Retail sales actually in
Sales
the US
1.6.
quite a strong rebound, 1.6 versus 0.9. A little bit better initial jobless claims, but that wouldn't be a market mover anyhow. But better core and retail sales and core retail sales 0.6 versus 0.2 and 0.8 versus 0.4. So basically both data beat, and that means that the USD against the CAD is going to be a little bit of a struggle, since as Blake mentioned, it would be a market mover would probably be getting good data for one economy and bad data for the other. But in this case, we got good data from both. That's why we see that we had an initial reaction, which got retraced actually. So we're exactly where we were before the data. Now let's have a look at what's happening in the rest of the markets. A little bit of a rebound here in the S&P. Let's see what the Euro USD is doing. Euro USD still at the lows of the day. USD yen a little rebound here. Regardless, keep in mind that the USD yen was in a horizontal consolidation, so there was nothing bearish with it in the short term.
Philly Fed came in weak 8.5 versus 10.4 expected.
10.4 expected, yeah. True.
And down from 13.7. So yeah.
Yeah, the rest of the data were rather good though. So
Yes.
basically, we don't see any big reaction. The dollar has been, even if we have a look at the dollar index, there you go. The dollar index has been breaking above this little channel here. So keep in mind that dollar remains very, very well bid. As you see, we found support at the 38.2 and channel support. So, as we were saying several days ago, the path of least resistance until proven otherwise is to the upside. And obviously, 97.70 is going to be a major level for both the bulls and the bears. We're not far away from that. We're at 97.40 at the moment. So let's see what happens if we get there, because on the daily chart we've shown that that's wedges the resistance. It has been a resistance multiple times in the past, and obviously if we do break above that level, that's going to be a major technical development and a very bullish one for the dollar index. Obviously, knowing that a huge chunk of the dollar index is the euro, that would be obviously showing that the Euro USD is going to remain under pressure. Euro USD anyhow maintaining this channel. We had a little overthrow, but keep in mind that 111.80 is a very, very strong area of support. We had this little inverted head and shoulders formation. We did actually make it to the target, but once we did, and we retested that area like 2-3 times, we failed. So now we're back on under pressure, falling below 1250. And as I said, next area of support is 111.80, but that's a major one. We already we had already tested that area twice in the recent past. If we do break below that, that's going to be a bearish development, opening up the door for levels lower than 111. Now, if for some reason we reverse higher and we break above 113.50, that's going to be a bullish development. But until that happens, we have no reason to be bullish the Euro USD. Now, the cable is also under pressure, and it's actually testing a confluence of supports, as you see here on the 4-hour chart. I have this trend line, ascending trend line support. You can view this as a triangle, which confluences with a 61.8 of the last move higher for the pair. Actually, this is the trend line, yeah. So, it's important to see if we're going to hold this 130 level to finish the week, because if we do break below 130, that opens up 129 and 128 below that. And, we will have another failure for the cable to push higher. You can also see it here on the daily chart. You can see how important this area is. If we did see a break above 132, that would be probably a nice sign that there is more upside for the cable, even a move towards this confluence of resistance at 136. But of course, this probability, this potential outcome, gets invalidated if we slip below 130, because then we open up a lot more downside. As you see, 128 is the next major area of support. So I think that's it with the cable, and until we break down or break higher from there, there's not much to do with the cable, as we've said. And even here with the Euro USD, you're seeing quite a strong move today. But from a technical standpoint, that strong move hasn't really changed anything, because the two areas that we are monitoring are still intact. We're actually more or less in the middle of this contracting range. So don't get overwhelmed by the fact that today's move seems to be quite a strong one, because that is absolutely no guarantee that there is going to be some kind of a technical development. Now, I mentioned yesterday, and Joe spoke about it, by the way. If you have not seen Joe's interview on Bloomberg yesterday, actually, you can find it on our YouTube channel. It's here is the last one. You can see in the last video we've uploaded. It's actually a nice one. He spoke about Aussie and copper. And we were talking yesterday here on the webinar about the potential of a concurrent breakout for the Aussie and and copper. I mentioned explicitly that we seem to be breaking higher, but of course we need to wait for the day to close. The reason I'm always very careful with saying that is because you never know what happens. And as you see, we got rejected once again from the 200 daily moving average yesterday. So what looked like at the beginning of the day as quite a strong bullish candle ended up as a spinning top, which is an indecision candle. And most importantly, once again, we didn't manage to make it above the 200 DMA, and that's quite important. At the same time, copper reversed, and from another candle that was looking like it was about to break higher, we retraced like half of the gains. We closed within this triangle, and today we're pushing lower once again. Now, does this mean that another false break higher is a better sign? No, not yet. Why? Because this trend line support is holding, and as long as it is, there is absolutely no reason why copper shouldn't push higher once again, and this time making it above it. So two things are certain here. One, we still remain in this contracting range, and two, in my opinion, when we do break above or below this contracting range, given the fact that a lot of stop losses have probably started accumulating both above and below, we should see a nice continuation move. Now, I still favor, from a technical perspective, a break to the upside. But you'd rather play the breakout so you don't have to guess or gamble in advance. Now, from what you've seen, it's best if you wait for a daily close confirmation than trying to play a breakout intraday, because we've seen several intraday attempts, failing, right? So let's actually wait for the daily close. So that's my update with this. Let me go through some of the questions. Nothing makes sense in these markets. Data beat out of Canada, bad data out of the euro this morning, yet EuroCAD rallies. I'm actually confused now. Let's have a look at the EuroCAD since you mentioned it. Let's begin by having a look at it on the daily chart. Now, I mentioned that the other day. I don't remember how many days ago we spoke about the EuroCAD, but we did. We had spoken about EuroCAD. First of all, just by zooming out, you can see that this is not a really nice chart to trade, right? I mean, there is no clear trend with the EuroCAD. So if I were to trade this, it would be at a shorter term time frame. So now, having said that, if I had to do something with it, as long as we remain above this broken descending wedge, which we retested, we retested its resistance and support. If I had to do something, it would be buying the lows. But I really don't want to do something with that. So I'm just saying that if I was forced to do something with it, it would be buying it. Other than that, I would advise for you to find something that's looking better. We're currently even in the middle of a recent range because, as you see, we've had a recent range which extends roughly from 149 to 150, 250. In between that range, there is an extra reason why you shouldn't be doing anything because we're in the middle of that recent range. So don't try to interpret like intraday moves so much, in my opinion. Just focus more on something. I mean, in my opinion, doing a top-down analysis is the best thing to do because you can, I usually try to find something that looks clean on, the weekly and the daily time frame, and then try to pinpoint, opportunities on the 4-hour chart. So I would advise that, more or less you do the same thing because, that keeps you from entering trades that actually have a, high chance of, chopping your account up. Let me see. We had more questions. Would you hold short indices during the long weekend? Uh, I think, yeah. If you want my opinion, I'll tell you something. As there is another jet that never short crude on Friday, the reason they say that is because whenever we have any unexpected events during a weekend, for example, usually those are crude positive. So when you have some big event that can really move the market, that's usually crude positive, usually. So I would say that with stocks being as overvalued as they are at the moment, I would say that, especially if I wanted to hold positions, in stocks for surprises, I would rather hold short than long because the market is already pricing in a lot of, positive stuff, rainbows and unicorns. So I would feel much more comfortable holding short positions if I had to do so during the weekend than the opposite. I think that even good news should not lead to any like huge jump. Of course, a possible China deal is an exception, but even that, as we've explained with Blake, the market has already priced in something very good coming out of a possible US-China deal, and I think that when we see such a deal, it's probably going to be underwhelming. So even that can lead to a spike, but I think that that kind of a positive spike should be short-lived. Psychological reminders trading is as much as technical. I agree with you, Craig, 100%. Let's see. Uh, can you only pick up the divergence? Answer my question. Okay, I'll have Dale answer that. Hey guys, when you get a chance, are there any other webinars? Yeah, Stelios answers that. It seems to me like you'd have to have stop buy set up at 134 and 134.20 in order to get USD CAD anywhere near those entry points that Blake wants it, assuming there is weak Canadian data and strong US data, right? I mean, won't there always just drive? Yeah, anyhow, that didn't manifest. Yeah, we're going to have eventually some educational webinars, that's for sure, but I cannot give you, a time horizon for that. DXY bull flag broken, says Zach. Yeah, I agree with you. I mean, as it seems, this channel has been broken to the upside, and this is definitely a bullish development. Now, would I be buying here since we're so close to 97.70? No, I wouldn't. I wouldn't, because nobody tells us that 9770 can't reject price action once again. We have now questions about the S&P and the Nasdaq. So let's have a look at both of these indices. Actually, let's go have a look at all the indices. So S&P still holding within what looks like an ascending wedge, but still, holding out quite nicely. I mean, we're still holding above this horizontal support area, which was like the first support area that we had. So in order for me to turn bearish, from a technical perspective, I need to see a break below this ascending trend line. So bottom line currently, let's say roughly a level of 28.75. Okay, until that happens, there's no real bearish development to talk about here. Same deal here with the Nasdaq. Nasdaq actually intraday pushed to all-time highs yesterday before actually reversing lower. Of course, that doesn't mean that that was a false break higher. I mean, we just had a little peak above. There is nothing broken with this uptrend in the Nasdaq for the time being. Even this ascending channel, and if you want to have a look at it as an ascending wedge by using this trend line as a resistance, uh, they're both holding quite nicely since support is holding. So nothing bearish with the Nasdaq. In order for me to turn bearish with the Nasdaq, I would need to see a move below 75.90. We're still some distance from that. Um, IWM looks somewhat weaker because we had this textbook corrective formation as a bull flag. And despite breaking higher, which was expected, we are still banging our head on this horizontal resistance area, being unable to penetrate through it. I was looking for a move towards the 78.6 at 163.10. So this hasn't happened yet. So obviously the Russell seems weaker for the time being. The DAX, on the other hand, and good thing I'm long here to counter, my S&P short, is doing very nicely. I bought the breakout from this bull flag, and I'm already a decent amount in the money. Of course, I'm keeping an eye here because, as you see, we have a confluence of 161.8% extensions, one from this move lower and one from that move lower, and this ascending wedges resistance. Both of them seem to be holding price action for now. Um, FTSE also holding near the highs, but keep an eye on this. This also looks like an ascending wedge, and we finally made it to the inverted head and shoulders formation from this bottoming inverted head and shoulders formation that we had. This ended up working quite nicely since we made it to the target. It wasn't fast, but it made it to the target. Also notice this RSI divergence here on the 4-hour chart. I have a small long here as well. It is in the money, but not a lot. It hasn't been moving that much. So probably I'm going to end up closing this position and keeping the DAX one since it's clearly overperforming. It is due for a reversal, but usually hitting Yada says it's reached all-time highs. It's due for a reversal. Surely, usually indices hitting all-time highs is a bullish signal and not a bearish signal. Like RSI hitting over both targets above 70 is usually a signal that you have strong upside momentum. So you should expect um, more upside. It's proven that momentum indicators, trying to fade momentum indicators, is a tactic that does not yield good results. Quite the opposite. I'm not advocating that somebody should be buying overbought readings on an RSI or any other momentum indicator, but it's proven that when you buy pullbacks after having overbought indications, it's a good tactic and a tactic that actually makes decent money over time. If you're into automated trading, actually. So I think this covers the question. So I can go ahead and cover some other stuff. Of course, if you have more questions, go ahead and use the chat. Now let's go through the metals. We already had a look at copper. Gold still consolidating below 1280. So, as long as that's the case, the path of least resistance remain lower, with this confluence at 1262 being the next downside target. Silver, this rebound definitely doesn't look impulsive in any way, but you need to respect the fact that it's holding above this 14 80, 40, 90 support zone. So keep that in mind. Now, if we want to have a look at platinum and palladium, let's go on the daily. Here it is, platinum, as you see, perfectly rebounded. This is what we were expecting up here, a retest of this breakout area and the move higher. So far, we retested this area and we are rebounding now. Will this lead to new highs? I don't know, but the fact that this support is holding should hold you off from being bearish. Platinum, palladium still looks to me like it's in a consolidation, which should lead to new lows. I would favor. I still have my last piece short here, and because I'm holding it, hoping for a move towards 1267 to take it off. I've already taken quite a lot of profits. It's been a good trade, but I think it can yield more profits if we break this recent consolidation. The next area of support is at 1263. Also, what do you mean by confluence? Is this an indicator? Depends on how you. For us, it is an indicator. The whole concept, whole concept behind the creation of Forex Analytics is our belief that confluences are very good signals for trades. By confluences, we mean when more than one types of analysis or more than one formations in the same type of analysis, or even better, when multiple formations from different types of analysis point you to the same direction. That's why we cover so many types of analysis, because we know as a fact that when you have more than one signals showing you that the same kind of movement should be expected, then the chances of that happening are quite increased. Speaking of which, let me remind, let me actually say it because we haven't said it yet. It's in exactly 1 week. In exactly 1 week, we have this event hosted. I'm going to put the link here actually in the chat. Here's the link. We have this event. It's organized by XTB. It's a broker, but we participate in it. Joe is going to be speaking. I might speak a little bit as well. We'll see. And we're going to have a presentation about this thing exactly. As you see here, please join us Thursday, April 25th, 2:45 p.m. British Standard Time, as ForexAnalytix presents to you the powerful uses of technical confluences. Discover the power of technical confluences as a method of pinpointing attractive risk-reward opportunities. Find out exactly what makes up a confluence, what tools we can use to determine whether or not a confluence exists, and how to utilize confluences to either join trends or identify key turning points in the Forex, and not only the Forex market. Unfortunately, if you are from the US or Canada, you'll get it, when you click to register for free, you're going to get a restricted page, because they're not allowed to serve the US. As you know, only 3 brokerage firms take US businesses. It's Oanda, Forex.com, and IG since January. But if you are from the rest of the world, you can register for free there and listen. And here's Joe, by the way. Listen to this presentation, and you'll get a good idea what we mean by confluences. Okay, perfect. So that covers the metals, and now nothing really has changed having to do with USD yen. If we have a look at the USD yen, I mentioned yesterday that as long as we remain within the symmetrical triangle, there is a possibility that we're going to move lower once again within the boundaries of this triangle. Momentum seems to have stalled. The upside momentum has clearly stalled. I mean, during the past 5 days. Does this mean that USD yen is going to turn lower? No, it doesn't, because actually, as you see, we remain within an ascending channel, and we're holding this horizontal support. So you can see this is like a little rectangle. So one thing is for sure, if we break above 112.20, I think we should see a little extension to the upside. If we break below this 111.70 area, we might see more weakness. Let me see. 9 hours, that's a marathon. Yeah, let me explain that. The master class organized by XTB is 9 hours, and it starts at 8 o'clock British Standard Time. Our presentation, so it actually hosts different people doing 40-minute presentations. So we are one of those people. I mean, Joe is going to be one of those people doing a presentation. Our presentation, which starts at 14:55 British Standard Time, lasts for 40 minutes. So if you only want to watch that presentation, you can just log in at that time and watch those 40 minutes. So that presentation is not that long. It's 40 minutes. Each of the presentations actually is only 40 minutes. So, if you want to watch a couple of them, it's not that long, Craig. That's it with USD yen because we had a question about it. Let me see if we had anything else. Okay, now let's go back to one of our recent favorite pairs, Aussie Kiwi. As you see, it's still holding nicely. Very, very nice, healthy upside momentum since we broke out from this wedge. And if you notice here, the RSI on the 4-hour chart also confirms another push higher since we broke above this trend line that was capping this little consolidation. So, respect the upside. As I said the other day, 1064 remains support. We didn't even make it down there. We almost did. So the next area of resistance is at 1075. I have no idea what you're sharing, but by saying oops, I'd rather not open it on the webinar. Now, let's have a look at the Kiwi. Kiwi, as you see, broke below this triangle, and actually after a little consolidation is pushing lower. So clearly the path of least resistance remains lower for the Kiwi. And as you see, we have a nice area of support at 66 cents. I don't really see any reason why we can't make it down there at the very least. So very clearly, path of least resistance remains lower for the Kiwi, and especially now that the Aussie USD got rejected once again from this horizontal resistance area and the 200 daily moving average. You can see it here, of course, because this is a 4-hour chart. We showed it before. This is another reason why you should expect that Kiwi might make it there. Because it would be quite hard, although they've recently diverged a little bit. That's why we've had this nice move higher in the Aussie Kiwi. It's going to be quite hard for the Kiwi to be plunging lower while the Aussie USD would be accelerating higher. So this rejection for the Aussie USD, can easily keep the Aussie still confined within this 70 cents to 72 cents range, while the Kiwi might make it down to 66 cents. Do you have an opinion? But Euro Swiss has actually become very popular recently. Yeah, I've been covering it every day because people are asking for it, and nothing has changed to what I said yesterday. Yesterday, what I said was be very careful because the Euro Swiss got found support at previous horizontal support area, but now we are actually testing this descending trend line resistance. And even if we break a little bit above it, we have this horizontal resistance area at 114.40, 114.50. So yes, my point of view is that you should be very, very careful with Euro Swiss here because there is a very decent chance that we're going to get rejected and remain within this range, this 111.80, 114.50 range. Now, if we decisively break above 114.50, I think that's going to be a nice buying opportunity because the next area of resistance is at 117. So that might boost the Euro Swiss and help it climb another 250 pips to the upside. But until that happens, I think that against 114.50, being short is a good risk reward opportunity. What is your country, mate? Yes, some countries unfortunately are restricted for the masterclass, but let me give you a little hint here. What I'm telling you is not actually illegal. That's why I'm telling you there is a way to bypass it. India, okay, there is a way to bypass it. You can use a VPN. So you can use a VPN and get an IP temporarily from like a European country, which shall allow you to do that. There are even free VPN clients, and there's some very good ones that are paid, but the monthly subscription fee is like very low. There are even some VPN, some good VPNs that offer like a trial period, like 10, 14 days. So you can actually do that if you want. Yes, they will be recording the webinar, and a few days after the webinar, we will be able to give you and upload on our YouTube channel a recorded version of it. So if you're not in a rush, that's also an option. You can wait for the recorded version of the presentation. Coach, do we have an interview?
Yes, Steve.
Okay, who do we have today?
Don Mead at 7 Sentinels.
Okay, so enjoy the interview, enjoy the extended weekend. Everybody have a nice time, and we'll be back on Monday. Thank you, Coach.
Oh, you're welcome, atheist. Happy Easter.
Thank you.
All
First
right.
of all, the Orthodox Easter is a week later. So even if I was a believer, I'm Greek. So for me, it's a week later.
All right. All right. Do you celebrate in the Trojan horse?
No. Last
All
time
right,
was
bro.
no.
Beware of Greeks bearing you know what. Anyway,
Oh, yeah.
Steve, great rundown. Don Mead. Don Mead. I think it's the third time we've done this, Don. I'm really looking forward to speaking with you, my trading warrior brother. You are now the presenter, and welcome back to Face, Don.
Thank you so much, Dale. Can you hear me okay?
Yeah, I can hear you. Can see your charts here, Don. So, first question is, after the break in December, the magnitude of the recovery surprised me. How about you?
It surprised me indeed. But as I'm going to show you in a few minutes, it's not totally out of place or a stranger or something that hasn't happened before. As Livermore always says, everything that happens in the market has happened before and will happen again.
I like that. And your tweet made mention of us making the same mistake for 89 years now. So can you tell us and the viewers and listeners what you meant by that statement?
Absolutely. Well, we're going to talk today about warnings and setups. You know, bear markets don't just happen. They don't appear out of nowhere. They follow long periods of setup or warning, and we're going to show those today. In fact, we're going to show 89 years of setups for bear markets that followed.
It takes time to turn a battleship around.
Oh, it sure does. It sure does. You think of the QE2 out in the middle of the ocean, heading, let's say, west. If you wanted to turn that battleship, or if you want to turn that cruise liner, in this case, going east, it takes a long time to turn that big mama around.
Yeah, which in the market we would call distributing stock to people.
Absolutely.
Okay, so I'm going to shut up for a while. Go ahead.
Okay. Thanks. I'll start by just a couple of opening comments. At the top of every, is this part up here in the corner covering part of my screen or not?
Your whole screen is up.
Oh, good. Okay. At the top of every page of 7 Sentinels, you're going to see these words: the most powerful trading concept on earth, period. And that trading concept consists of 3 simple words. And at the end of this interview, I'm going to tell you what those 3 words are. So let's hold that thought for the moment. Jesse Livermore wrote in Reminiscence of a Stock Operator that most traders give far less thought to any given stock purchase as they do to the decision to buy what he called in those days a motor car.
Okay.
So by extension, we would wonder how many that would buy an auto would do so if they had compelling evidence to show them that that particular auto was almost certain to crash within the first few months it was owned by the buyer.
Okay, Don, do you know if Jesse wrote that book before he committed suicide? I'm kidding.
Well,
he had to have.
He didn't actually write the book himself.
Okay.
Jesse, Edwin Lefebvre was a writer in those days who sat with Jesse Livermore for hundreds and hundreds and hundreds, thousands of hours interviewing him. And everything that is in that book was written by Edwin Lefebvre in the voice of a fictional character who was in fact Jesse Livermore. So the book is true, but it's based on the life experiences of Jesse Livermore.
Okay.
And it was
a lousy joke anyway.
Pardon?
And I learned, so I thought he wrote it. So interesting. It's called Operations of a Stock Operator, right?
Yes, Reminiscence of a Stock Operator.
Okay. Everyone should read it.
And you may know, just as a side note here, that in the 1929 to 32 bear market, Jesse Livermore turned his trading account into over $100 million, which in today's dollars is $1.2 billion. And he started from $5. In fact, his first and last job was when he was a teenager as a board marker for one of the brokerage firms. He spent his entire life doing nothing but trading. And he was an interesting character, to be sure. But I've learned more from Jesse Livermore than from anybody else. Let's take a look at how markets do set up or prepare for bear markets. First of all, we're going to start by talking about the McClellan oscillator. What you're looking at right here is, I'm going to see if I can drop that off my screen. Oh, well. Anyway, what you're looking at right here is the Standard & Poor's 500 over the last 7 months. Here was the S&P 500 coming down from the September high of 2018 to its low on Christmas Eve. And here is that bear market rally that you and I began this conversation talking about. That has been indeed one heck of a rally, 650 points or 550 points, I guess it is.
Relentless.
On the Standard & Poor's 500. What you're looking at next is the McClellan oscillator. And I assume that most listeners here are familiar with the McClellan oscillator, but it is a measure of market breadth. It uses moving averages of the advanced decline line to measure market breadth. And when the McClellan oscillator is at a high number, it means that the upside momentum in the market is very strong, like back in here. Boom, it comes up to a high number. As the rally goes on, the upside momentum weakens. Now, that is a McClellan oscillator. Now let's talk about the really important part for today's dissertation, if you will, and that is the McClellan summation index. Okay. If you take the McClellan oscillator reading each day and add it to the running total through the prior day, you will have the summation index. So if the McClellan oscillator readings are positive readings, then each edition will take the summation index higher. If the McClellan oscillator readings are negative numbers, then that will take the summation index lower. So since that low on Christmas Eve right here we saw the market rally up. But during that period, the summation index initially went substantially higher all through January and into late February.
Is this
Then
what
there
most
came a
technicians, Don, were using for the case of market breadth making new highs back
yes,
there? Okay.
yes, absolutely. Then there came a time when, as the Standard & Poor's continued going up through March and April, the summation index was actually falling. And that's what's been going on now since late February. We've had an advancing Standard & Poor's against a falling summation index. This is key to today's discussion, because if we go back now and look at 1930, well, first of all, yes, this is 1930. Look at the similarity in that pattern, Dale. You see the 1929 market peaking in August. Sounds familiar, doesn't it? The 2018 market peaked in August. Then we see it coming down and kind of crashing into late in the year. And then late in 1929, when it finally hit a bottom, it began advancing clear into April of 1930, very much like this chart of 2018, 2019. You see the similarity.
Yeah, the one similarity I don't see, Don, is the magnitude of the retracement. Does that bother you?
Exactly. The magnitude has not been the same, although in percentage terms it has been, but the magnitude of the rebound in 1930 was not as strong as the magnitude of the rebound in 2019, but the pattern is the same, and it's a pattern that we're going to be talking about today.
And each one of these things that you're talking about are one of your sentinels.
No, we're not actually going to be talking about the sentinels themselves today. We're just going to talk about the summation index and how it warns us of an oncoming bear market.
Okay, Don.
As we came up in 1930 from that November crash low, you see that the summation index was advancing with the Dow Jones Industrial Average. They're advancing together through November, December, January, February of 1930. They're advancing together. Then there came a point where in February of 1930, the Dow Jones Industrial Average continued advancing, but the summation index began declining. Sounds familiar. We just talked about that because that's occurring right now in the year 2019. Ultimately, what that led to, and here it is again, the Dow Jones is advancing, and it's still advancing, but there came a point when the summation started going down as it was advancing. That ultimately led to now back way up. Excuse me, I still have a cold I'm getting over. But that, if we back way up, now we're looking at about a 3-year chart of the Dow Jones Industrial Average, so that you can see this period that we just looked at as part of this overall chart. This is the 1929 low. This is the rally into 1930. This is when the Dow is going up with the summation confirming it all along. And here's where the Dow then starts going up and the summation is declining into April of 1930. That was the warning. We had a healthy advance in the market with the summation confirming. Then we had an unhealthy advance in the Dow 30 with the summation declining. And that was the warning, Dale, and that led to the 1930, 31, 32 bear market that ultimately took the market from the 1929 high down by some 90%. Again, as you pointed out, the amplitude of the move in 1930 is very different than the amplitude of the move in 2018-19, but the pattern is the same. Let's look for the same pattern. Well, let's go forward a few years to 55 years ago. Interesting, another Fibonacci number, because we just looked at 89 years ago. 55 right. years ago, as we were in 1973, 74, again, the markets were moving up. This is the Dow Jones Industrial Average, with the summation index confirming all the way up in late 71 into 72. Then there came a long period of time in 1972 where as the Dow Jones Industrial Average was moving higher, the summation index was moving lower. That was during what they called the Nifty 50 era. I don't know if I remember. You're probably old enough as I am to remember that. Yep. When there were like 50 stocks, Disney and Xerox and IBM and McDonald's and so on that were the top 50 stocks, but the broad market was not following. Okay, then
so you got to pull back.
You do. Good.
Okay. So let me ask you this. You can't use it as a timing tool. It's more of a bias tool. Would you say that?
Exactly. We have plenty of timing tools here at 7sentinels.com, but this is not one of them. This is a broad warning over time that tells you the setup that we're in.
Okay.
Yes, thank you for pointing that out. Okay, then in late 72, again, we have a healthy period where the Dow is going up, confirmed by the summation. Then we have a period of time where, again, the Dow keeps going up, but the summation is falling. That immediately preceded, boom, the great bear market of 1973, 74.
That lasted till 82.
Yeah, well, yes.
It was a big range. I mean,
yeah, it did. It was in a secular bear market, really, from 1965 to 82. Absolutely.
Yeah.
But this particular cyclical bear market lasted from the peak in 73 into a low in late 74. But you see the setup and then the outcome.
A lot of these declines about 18 months, Don, or 2 years.
Yes.
Bear markets.
I'd say 18 months is a good average figure. I've used 18 months as an average figure for some time.
Okay.
Although 1932 was more like 3 years.
Yeah.
And there have been a few that have been as short as maybe 6, 7, 8 months. Let's skip to 1980, same thing. The Standard & Poor's is moving up. Summation is going up with it. Then we have a long period of time where the Dow Jones is going up and the summation is falling. Warning period. And boom, this is what followed. In 1980, 81, 82. Again, here's your 18 months, Dale. Then in 1987, everybody remembers the crash of 87. That crash of 87 didn't come out of the blue. That was no big surprise to people that were paying attention to what the summation index was saying, because as the market was going up, there was a healthy period where the summation was going up. And then all through 87, the Standard & Poor's kept going up and up and up and up, and the summation index was falling, and that led to, boom, the crash of 1987.
Yeah, I went down stairs from my office, took the elevator downstairs to see if the bank was still open.
Yep.
And I went in there and they go, I go, well, the market's crashed. And they go, oh. I said, all right, I'd like to make a withdrawal.
I bet you weren't the only person.
No, it was empty. There was no panic in the streets, only on the Quotron machines.
Yeah.
The green screens, right, man?
Exactly.
So, all right.
Turned red that day.
Yeah. Okay.
Okay, so going on, same thing again in 1998.
Asian contagion.
same setup. Yeah, as setting this is leading into the 2000 market top, long period of healthy advance, and then a long period of unhealthy advance, as I call it, where the averages are moving higher, summation is moving down. That was a warning. Here's what happened initially in 98. Then we had it. This whole thing continued in 99, advancing market, falling summation, and boom, here's what happened over the period of 2000, 2001, 2002.
Yeah.
Most here probably traded through that market and remember it well. But the warnings were there, and that's my point today. But they were ignored.
For my WorldCom stock today.
Pardon me?
WorldCom. Or, I'm talking about things that went away. Anything.com.
Yeah.
All the things that went away.
The big
Yeah.
.com.
There were survivors. There was Cisco and,
Well,
some of them
Amazon
maybe.
actually came out of that.
That's right. Yeah.
So there.
So
there
at
were
every
few and far
end, there's
between,
at
but,
every end, there's a new beginning.
Yes. Oh, good. Well said. Okay. 2006, same thing. Healthy advance, unhealthy advance with the summation declining, and boom, here's what followed. 2007, everybody remembers the peak in 2007, the real estate boom.
Yeah.
Here we have healthy advance. Here we have the unhealthy advance all through May, June, July of 2007, setting us up for boom, this whole thing that occurred in 2007, 2008. My point again is nothing happens out of the blue. We had adequate warnings, and those warnings were ignored by the crowd. Excuse me again. Okay. That takes us up to 2015. We all remember 2015. Here's that healthy period in early 2015 as the summation was going up. But then here's this long sustained period from May, June, July of 2018. Seemed long at the time, while
15.
the S&P was making new highs. But look at this summation. It's just going steadily lower, 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 lower. And look what that led to. Again, boom. The warnings were there. They went unheeded by most, but those who were paying attention traded, at least got out of the way of this, let's hope. And many of us traded it short. It was a marvelous market for that period, or for that purpose. 2018, here we are. Last year, as the market came up all through 2018, made highs in first in June. You see the summation advancing. Then starting in June, the market continued going up into its high around September 1st. And look at this summation, down, 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 all through July, August, into September, as Standard & Poor's was making new highs. And
let me ask you this, Don,
here's
from
what
the
followed.
initial
Yep.
momentum peak of the summation index
Yes.
to where it begins to decline, is there an
Yes.
average time period before the market recognizes it?
Yeah, there's an average, but I don't
Okay.
believe much in averages. If your feet are in the freezer and your head is in the oven, would you say on average you feel pretty good?
It depends what I'm garnished with.
Right. You got it.
Okay, but anyway, I thought
Anyway,
it looks like
my
to me,
point is
just
that
an observation looked like 6-8 months from.
it is, and that is a good observation. I do talk about averages a lot, but the
Okay.
problem is that a lot of things fall outside of the averages. But yes,
Right.
yes,
Yeah.
that is
Okay.
that is an excellent observation. So where does that leave us right now? Here we are, 2019. As the market came off of that December 24th low, rallied. There came a time at the end of February where this healthy stage of advance, and in this case it was about 3 months, came to an end as the summation index began going down. That's been going on for now like 2 months. In fact, when you take a look at the excuse my cold here, but when you look at the current market, it looks an awful lot like the 1930 in shape, not magnitude, as you correctly point out, but in shape, it looks almost exactly like the 1930 market all over again. And so, what are we set up for now? Well, the crowd is as bullish as ever. They're out there buying, but those serious traders who are paying attention are buttoned up and ready for the decline. Now, you asked me about signals, timing tools. We have plenty of timing tools, and we're just waiting for the ultimate signal that could come as early as today that takes us into the next stage of decline. We'll talk about that on another interview. But at any rate, we've been talking about 89 years of warning, and it makes me think of a line from the movie Margin Call. Did you ever see that, Dale?
No.
Yeah, I'm going to tell you again, like I did the last interview. You've got to watch that movie. It is so good.
Is it on cable, or where do I find it?
Oh, if you have
when was it made?
If you have on demand, you'll find it on one of the Showtime or HBO or one of those.
I do.
Or
I have a long weekend. I promise to do my homework this time, Don.
Watch Margin Call. You're going to love it. But these guys in 2007, 2008 figured out that the markets were getting ready to crash. In their case, it was the bond markets. And at one point, when they figured this out and they're getting ready to take action on it, they're driving around the streets on their way back to the office. And one of the characters, Peter Sullivan, says, look at all those people wandering around with absolutely no idea what's about to happen. And I feel that way many times when I watch a setup take place like this.
Sometimes I wish I were them.
Pardon me?
Sometimes I wish I were them.
Yeah. But my point is, we don't have to be bystanders. We don't have to be sitting around in ignorance. We can pay attention. We can see these signals. And we've been talking about warnings today. There's I think the Chinese have a saying about something about on a coin. The two sides of it are crisis on one side and opportunity on the other. This crisis that is formulating now for markets for the next couple of years is a major opportunity for those that know how to step up and take advantage of it.
The danger of a crisis is to miss the opportunity.
Yeah, very good. I like that. Can I quote you on that?
Yeah. I stole it from the Chinese. It's my derivation of the Chinese expression. I was just going to say that. You know, you and I, in many ways, are cut from the same cloth, Don. And I really recommend people go check Don out and his website, and at the minimum, follow him on Twitter at 7 Sentinels. And Andy Kaufman is his icon, who does a little, little Elvis. I'm all shook up. And
thank you very much.
Yeah. So, Don, a great presentation with this, and
thanks. I did tell you I was going to give you 3 words at the end of this program that explain what we mean by the greatest concept on earth for traders, and that is price follows breadth. If you don't remember anything else from today's interview, remember price follows breadth. Breadth gives you the pathway to what price is going to do in the future. You need to follow it. So that's it. And I will say one last thing, and that is, if you go to the 7sentinels.com website, we are running a limited time trial of 17 days for just $9.95. If you click on there, it'll get you all set up. So that's it for today, Dale. I thank you so much. It's always a real pleasure to be with you.
Don, happy Easter, and have a great weekend. And really, by now that we're brothers in more than one way. Absolutely. As trading warrior brother.
Absolutely.
And Don uses the term rainmaker trades, which is You know, you could be out there in the fields and you really need the rain so your crop could come in and have a bountiful harvest. And may you ride this decline and max it out, Don, and all your subscribers reap the harvest with you.
Thank you so much, Dale. I really appreciate it.
Okay, everyone. That's Don Mead at Seven Sentinels, and that's a wrap for the week. Remember, don't just count your pips, count your blessings. Thank you, Hamed. Happy Easter to you. Don, good hunting, and do your work over the weekend and watch Margin Call. Happy Easter, Alina, and see everyone on Monday. Thanks once again, Don Mead.
Thank you.
Adios, Face and investing.com. See you next week.